Whenever a company announces its results, the headlines are almost always the same. Revenues increased by 20%. Sales figures crossed 10,000 crore rupees. Record growth achieved. And everyone gets excited after hearing that. But do you know what investors, finance professionals, private equity firms, and the interviewers immediately ask after hearing that? They ask, okay, but how much amount of that revenue has been actually converted into the profit? Because revenue alone does not tell us whether a business is healthy or not. So, how do finance professionals figure out that? They look at one of the most important financial statement, that is the income statement. So in this video, I will show you how finance professionals read the income statement from revenue all the way down to the net income. Let me ask you a real question. The company's revenue increased by 20%, but does that mean the company's profit also have to grow? Some would say yes, but the answer is no. And in today's video, we will see why does that happen. Think of the income statement as a movie, not a photograph. A movie? Why? Because it tells the story what happened to the company during the period of time. How much the company generated revenue, how much costs it incurred, and ultimately how much profit it generated. This is what finance professionals look for. So, this is the complete flow of the income statement. Don't worry if it looks very complicated, but in the end of this video, every single line will make the perfect sense. And most importantly, you will understand how finance professionals think when they analyze the business. So now let's assume we own the company called ABC Limited, and ABC Limited generates rupees 100 of revenue during the year. Now we will see out of this rupees 100 of revenue, how much the company actually generates the profit. Everything starts with revenue. एप्पल आईफोन सेल करता है, रेवेन्यू। स्टारबक्स कॉफी सेल करता है, रेवेन्यू। सर्विस फर्म्स प्रोफेशनल सर्विसेज प्रोवाइड करती हैं, रेवेन्यू। डिफरेंट बिजनेसेस बट द सेम स्टार्टिंग पॉइंट, दैट इज रेवेन्यू। एंड इन आवर केस द कंपनी जनरेटेड रेवेन्यू of rupees 100. But here is one interesting point, and note down my words. Revenue is often the easiest number to increase. And why do I say that? हम अपने प्रोडक्ट्स पर डिस्काउंट्स प्रोवाइड कर देते हैं, द रेवेन्यू विल इंक्रीज। हम अपने प्रोडक्ट्स का प्राइस इंक्रीज कर देते हैं, द रेवेन्यू विल इंक्रीज। हम कोई दूसरी कंपनी एक्वायर कर लेते हैं, उनके रेवेन्यू भी हमारे फाइनेंशियल्स में आ जाएंगे, द रेवेन्यू विल इंक्रीज। बट none of these guarantee the higher profit. अब हमने जो प्रोडक्ट सेल किया है, उस प्रोडक्ट को बनाने के लिए भी कुछ कॉस्ट लगी होगी, राइट? उस कॉस्ट को क्या बोलते हैं? द कॉस्ट ऑफ गुड्स सोल्ड। फॉर एग्जाम्पल क्या क्या कॉस्ट लग सकती है, जैसे कि रॉ मटेरियल, direct labor, manufacturing expenses, packaging and other direct costs. All these costs are related to the cost of goods sold. And in our case, let's assume the cost of goods sold is rupees 60. So out of 100 rupees of revenue, rupees 60 is already gone. When we deduct cost of goods sold from the revenue, we arrive at the gross profit. And in our case, revenue was rupees 100, cost of goods sold was rupees 60, and the gross profit would come at rupees 40. And this is one of the first numbers that investors or finance professionals analyze, because it tells us whether the actual product or service which is sold is actually profitable or not. Gross profit is before salaries, before rent, and before other expenses. And hence, gross profit helps to answer whether the core business is attractive or not. So now हमें बिजनेस रन करने के लिए एम्प्लॉयज की रिक्वायरमेंट रहेगी, राइट? एंड हमें एम्प्लॉयज को सैलरीज, बोनसेस, पीएफ एक्सेट्रा भी पे करने रहेंगे, राइट? सो these costs are employee related costs and these fall under personal expenses. Let's assume that in our case, personal expenses is rupees 10. So our profit would reduce from now rupees 40 to rupees 30, right? Because personal expenses are rupees 10 and our gross profit was rupees 40. So 40 minus 10 would be rupees 30. And in the firms like consulting firms, services firms, these employee expenses are the biggest expenses in the financials. So apart from employees' expenses, there are some other expenses which the company is required to do to run the business. For example, rent, marketing, travel, softwares, utilities, and some other miscellaneous expenses which the company is required to do, right? So these kind of expenses fall under other operating expenses. And let's assume that for our company, the other operating expenses are rupees 5. Then the profit reduces now from rupees 30 to rupees 25. Coming to the other operating income. Starbucks ने coffee sell की, so that would come under the revenue. But apart from that income, there are some other incomes as well. For example, government grants, foreign exchange gains, rental income, which are not the part of the main business, right? Selling the coffee by the Starbucks is the main business, but these kind of incomes are not related to the main part of the business, but they support the operating activities of the business, right? So these incomes, these kind of incomes fall under other operating income. Okay. So let's suppose in our case, the other operating income is rupees 2. So now our profit will now increase from rupees 25 to rupees 27. So these kind of other operating incomes, finance professionals, investors generally analyze to see that whether they are one time or recurring, right? So because it significantly affects the valuation. So this we will discuss later on when we will discuss the advanced topics. Now we have reached the most important aspect of the income statement, or I would say the most important aspect of the finance, that is EBITDA. Every finance professional, every investor, every private equity firms want to know what is EBITDA of the business. So let's calculate it. So our gross profits were rupees 40. Then we deduct the personal expenses, which were rupees 10. Further, we deducted other operating business, which were rupees 5, and then we added other operating income, which were rupees 2. So our final EBITDA arrived at rupees 27. Right. So why EBITDA is important? Because it is related to the core operating profitability of the business before any financing decision, before any accounting policies come into the picture. So this is the most important part. We will discuss it in much detail later on. Now come to the component depreciation and amortization. Suppose ABC Limited machinery purchase करता है for rupees 50, but that 50 we will not charge immediately. Okay. Instead, the cost of 50 rupees would be spread over its useful life of the machinery. मतलब हर एक मशीनरी की एक यूजफुल लाइफ होती है. For example, let's take in this case is 10 years. Okay. So rather than charging 50 at one time, हम उसे annually charge करेंगे over the next 10 years because हमें उसकी वैल्यू बेनिफिट नेक्स्ट 10 years तक मिलेगा. ओके. सो 50 divided by 10 we will charge rupees 5 every year, and rupees 5 expense that we will be charging every year is our depreciation. Okay. So it is a non-cash expense because we are not paying any cash. We are only decreasing the value of asset over its useful life. Okay. So this is depreciation, and if it applies on the tangible assets, and if the same is case on the intangible assets like softwares, etc., then that would be known as amortization. So this is depreciation and amortization. So in our case, depreciation and amortization arise at rupees 5. After deducting depreciation and amortization from EBITDA, we will arrive at EBIT, that is earning before interest and taxes. Okay. So our depreciation and amortization was rupees 5 and our EBITDA was rupees 27. So EBIT would be 27 minus 5, that is rupees 22. So it is a profit after considering operational costs and asset usage. Why operational costs? Because we deducted a cost of goods sold, personal expenses, other operating expenses, right? And why asset usage? Because we deducted depreciation and amortization, which is related to the expense on fixed assets. So after EBIT, we would come to the component of interest expense. Suppose ABC Limited have taken a loan of rupees 40, and on that it is paying the interest at the rate of 10%. So the interest would be 10% of rupees 40, that is rupees 4. It means ABC Limited rupees 4 interest पे कर रहा है हर साल on the loan. इसलिए डेट जितना ज्यादा होगा उतना ही कंपनी के लिए डेंजर ज्यादा होगा, बिकॉज अगर उनका प्रॉफिट बहुत अच्छा भी है बट उन्होंने डेट ज्यादा लिया हुआ है तो इंटरेस्ट ही उनके मैक्सिमम प्रॉफिट्स को खा जाएगा. सो हाई डेट कंपनीज आर क्वाइट dangerous. So EBIT was rupees 22 and our interest came out to be rupees 4. So now our earnings before tax would be rupees 18. That is earning before interest and tax, that is rupees 22 minus interest expense, that is rupees 4. So rupees 22 minus rupees 4, that would be rupees 18. So this would be our earnings before taxes, right? And let's assume our taxes are rupees 6. And after we deduct taxes from earnings before tax, we would finally arrive at our net income. That would be rupees 18 minus rupees 6, that is rupees 12. And this would be our net income. So the company generated revenue of rupees 100, but the net income came out to be only rupees 12. That's why finance professional investors don't stop at revenue. They check the whole journey from revenue to the net income. Let's recall and see how revenue of rupees 100 becomes net income of rupees 12 in the end. Kindly go through the slide for 30 seconds. So the next time when you hear someone saying the company generated 10,000 crore rupees of revenue, don't get impressed by the numbers immediately. Ask them how much gross profit did they generate? What happened to the EBITDA? How much profit did they keep in the end? Because this is how finance professionals think, right? So in the next video, we will move to the balance sheet section and will answer one important question, that the company generated profit, but where did that profit actually go?